Hey, everybody, and welcome back to the Teaching Tax Flow Podcast, episode 184. We are going to explore another case study from the Defeating Taxes book. So I would love to take credit for this. I can't at all. I'm not the one that wrote it. My esteemed, handsome co-host, Chris Pacuro, is back again on his own show, and we're going to dive into this. So, Chris, give us a little background about this specific case study. I know this is the number 2, the second one we're looking at.
Yeah, so thanks again for the warm introduction. We're looking at Defeating Taxes, this case study, and Sarah. We're going to talk about Sarah today. Sarah was inspired by a couple things. One is that my wife, when I met her, she was in her mid-20s, and she's a public school teacher, and now she's not in her mid-20s, even though she probably looks like it. And she doesn't even watch this anyway, so I should have saved my compliment for later. But she also works with a lot of teachers just getting out of school, college, in their mid-20s. They a lot of times have a modest income. But when they start their job, and they're told to think about retirement, which is very smart. And however, a lot of times they just go in and they start putting money into their retirement plan pre-tax to get a tax reduction the year that they that they're in their mid-20s, when many times in the teaching tax flow system, we realize they're in a lower marginal tax rate, what we call green. Green is a lower marginal tax rate instead of what we call a red diagnosis, which is higher marginal tax rate. So the point is, you want to diagnose, then prescribe. So this goes beyond just Sarah, who we're going to talk about from the book. This is going to be anyone that is in that lower marginal tax rate, especially if you have a lot of years to continue working, because we're going to talk through the power of GOLD, which is our tax-free income and growth strategy as well. So yeah, this case study is near and dear to my heart, but it doesn't have to be a public school teacher. It could be, it could be someone getting started in the building trades. It could be anyone. In fact, John, just earlier this season, it felt so good. And my 2 older kids are now 17 and 16. They had W-2s and they worked at, one of the kids who helped us out here, but also worked at other places. My daughter's very ambitious, which is great. But we were able to, my wife and I ended up contributing to their Roth IRAs. And I educated them about a Roth, and they're probably thinking, that's cool. So, in a long time from now, I'm going to have a lot of money. But it felt good to do that. So why would I put money into a traditional IRA for my kids who are at a low marginal tax rate, actually 0% tax rate, when there's no big benefit? So let's think about Sarah, right? So Sarah, and I think we know Sarah's in our life. So Sarah just represents that taxpayer that's in a lower marginal tax rate. In our book, this Defeating Taxes book, and John, don't sell yourself short. You wrote a very nice forward to it, and that's what people read first, right?
Hey, I'll take it. And honestly, with this case study, oh no, go ahead.
No, I mean, hopefully it's good enough where they keep going into the actual book. So, but we'll see.
Hey, if somebody stops at that, then you can just blame me. Hey, you're missing out everything. But these case studies, I do like how you position this in this book, right? So again, you mentioned this one. Really, it's kind of by default a little bit nature of the tax system. People that fall into that early career naturally are usually a lot younger. So there's a lot of similarities. And I like that you mentioned too, it doesn't have to be a teacher. That's just the example we used. And then obviously the other case studies, we're going to do one at a time, sprinkled out throughout these podcasts. We'll get all the way into people that are in retirement. But this one is great because I think it goes back to really like the root of teaching tax flow, right? Where people might say, well, what the heck is tax planning and strategy? It's not for me. I'm either at this stage or I'm too young or any of this stuff, where you can see that the little activity, the little acts turn into something huge, down the road too. It compounds itself. So this is great.
Well, great point. And one of the things we talk about, and one of the reasons that I wanted to create Teaching Tax Flow, is that tax planning and strategy is one of our myths. So we talk about in the book too, is it's not just for high income and high asset households. I truly believe the Sarahs of the world, the lower to moderate or modest income households, can benefit more from tax planning and strategy, because the amount of disposable income we could free up as a percentage of their of their income could be higher. And this is the reason we put this in the book as a case study, is that we want everyone to realize no matter what your income level, no matter what your asset level, there's opportunity for you. So like Sarah, she's 25, she's a young school teacher, she's single, she doesn't have a dependent. Back in the day, she might have been able to deduct her dog. She's got a cute dog, but unfortunately, that's not a dependent. Now, so she's got it, and she lives in a tax state with no income tax. So her marginal tax rate's only 12%. So at this stage of her life, she doesn't really have meaningful savings or liquidity. She might be renting an apartment, maybe sharing a home with friends. And each year you know, the last couple of years as she's gotten into the workforce, she's actually not really thought about taxes. She would have her taxes prepared. She probably actually might have used a self-service tax preparation, which is fine. And she got a refund of about $2,000. Now, $2,000 to some is not a lot of money. To some is a lot of money. But that extra couple $100 a month approximately in Sarah's pocket could really help her out. So she's thinking, all right, and I have to start thinking about maybe saving for a home down the road. And so what is she here? Well, she's what we call, like I said, the green diagnosis, right? Which is a lower marginal tax rate, and gold diagnosis. Now, for tax-free income and growth. Now, Sarah's probably putting money into or paying for some of her health insurance pre-tax, which is great. Sarah's probably covered with a through depending on where she teaches, or she could be part of a teaching union. She might not be a part of a teaching union. So she probably has some employee benefits, so she's putting money away pre-tax. However, if I'm talking to Sarah, what I'm talking to her about is making sure that she's putting money into retirement, but I would deeply, deeply consider a Roth retirement contribution. Because why? Well, because that's going to grow tax-free over the course of her life. And two, a 12% tax benefit right now isn't that spectacular. So let's say Sarah puts, $3,000 into a retirement account. If it's that Roth and it doubles 5 times before she retires, and I got to do mental math, that 3 becomes 6, 12, 24, 48, $96,000 of tax-free assets for Sarah when she retires by just changing it. Now, if she put it into a traditional retirement account, she would save 12% of the 3,000. So it'd save her $400 ish. But wouldn't you rather have that $90,000 plus when you retire?
And circling back just a little bit too, if anybody kind of feels like, all right, crap, at this point, yep, I see it. This is kind of trajectory. Okay, I wish I would have done this. I already haven't, but maybe I start now, right? Like a lot of these, I wouldn't say the impact isn't there. You can start at any time, whether you're 20 or 55, 60, right? It's just, it doesn't do that. It doesn't compound as much. Like it still grows. But back to what we were saying earlier, I think was super impactful, and just make sure everybody understands this, right? When you talk about that marginal tax rate, not a tax bracket, that's a whole other topic people can look at.
Sure.
It's actually a lie. Chris will talk about that a little bit more. But whatever that tax rate is when you're younger, naturally you're not making as much. So you're not paying as much in taxes. We definitely won't get into, oh, well, I didn't owe anything in taxes, but I'm getting a refund, right? So technically you've overpaid, which is another topic. But putting that in when you're younger, you might have more flexibility in your life too to contribute to that than, when you have 3 kids at home and, diapers get super expensive and, you know, utilizing
Absolutely.
that time.
This podcast is sponsored by REPStracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. REPStracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, REPS, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the REPStracker sign-up page.
I get to speak, with my wife when she put money into her retirement when she was younger. Could she have a little bit of a nicer car with that extra $100 a month back 20 years ago? Sure. But what do we have now? It's grown and it's, and now I wish, Roths really weren't a big thing then. I wish they were in Roths, not pre-tax accounts, but that's why we wrote this darn book, and that's why we're trying to help people out. So yeah, absolutely. For someone like Sarah, putting money in, even if it's 2% of her income, 2% into the Roth, at least put enough in to get the match from your employer. If you fill up your Roth, maybe do a Roth IRA. But here's the thing with Sarah and anyone in this situation. And I've learned this through athletics, through talking to listening and learning from very high achieving people. Practice does not make perfect. Practice makes habits. So with Sarah, that practice of, hey, maybe it's 2% of her income, pick up a match. It's okay. She's getting in the habit of putting money away for the future for her. If I'm Sarah, I'm thinking, or someone like Sarah, I'm thinking about putting money in a health savings account. Again, something I wish my wife and I did a long time ago. Now we use our HSA money all the time because our kids are, now we have 3 teenagers in the house, and we're pretty active. So we're always hitting our head on something, or, we're sniffles and eyeglasses and braces. However, when my wife and I were in our early or mid-20s, even in our early 30s, in hindsight, we should have put, even though we're in a lower marginal tax rate and we didn't really have a lot of health expenses, we should have put money in the HSA. So for Sarah, she's healthy, she's in her mid-20s. It doesn't hurt to put money into that health savings account now, even if she doesn't use it, and she'll have it down the road, tax-free to grow. So remember that health savings account's that TriStar, like the state of Tennessee, right? You get that tax deduction when you put it in. The money grows tax deferred. The money comes out tax-free if it's used for medical expenses.
Basically, what Chris didn't mention is that he's extremely lucky that none of his children played hockey, or what we call the hockey health savings account, because, it beats you up pretty bad. Speaking from personal
I know, though,
experience.
some of these,
So,
that's an interesting. Some of these sports, especially the travel sports, are very expensive. But then you run into legacy costs of your health, right? And I think hockey and tackle football definitely are the ones that you see a lot more lingering injuries around the body. But so yeah, so for Sarah, and especially at this age, another thing she might be doing is she might pick up a second gig. And a lot of times teachers might teach summer school. Maybe they coach one of the sports teams. Maybe they coach a club sports team. Who knows? So she might have some income outside of her W-2 wages, and she might want to put some more money into a Roth IRA. It's just, the point is, hey, let's take, and this is tax planning 101, let's take things that you're going to spend money on and make it as tax efficient as possible. Medical insurance, out-of-pocket medical expenses. So let's make sure we're going pre-tax with our medical insurance. Let's make sure we're making HSA contributions for those medical expenses today or in the future. And then the other thing, retirement. Let's put money into retirement. And since you're in a lower marginal tax rate, like a Sarah, let's look at those Roth type accounts and really start thinking about this. So, and then with Sarah as well, as can she start taking some money and putting it into an emergency fund or maybe a savings account for purchasing a home? Then maybe that's one of her next kind of, her next stage. Who knows? She might be looking at going, continuing her education. We just don't know. But the point is, even someone like Sarah, like we talk about a lot in our Teaching Tax Flow community, if you take if you're trying to drive from one place to the other, and let's say it's a 600-mile trip, and let's say you kind of get off on the wrong exit, which, hey, we've all done it, right? And you go a mile down the road and you realize it and you turn around, okay, big deal. But if you go 200 miles down the road and realize it, now you've got a problem. So Sarah, start these habits as you're in your mid-20s, as you're younger. And again, those habits or practice makes habits.
absolutely. And I know before we get to really that last stage, because we're following the 4 steps with this example here, is, if anybody's at this stage, and this is a genuine question offered everybody, I think, just from Chris, myself, anybody in Teaching Tax Flow, just ask the questions. There's the whole Defeating Taxes, and this is not a pitch, Defeating Taxes Facebook group. Get on there, ask any questions. Don't feel dumb, because if you ask these questions earlier on, there's a million I wish I would have asked. Even my parents, I didn't bother to ask them. There was no Facebook back then. It was before MySpace. Ask the questions and just know what you're getting into. Even if you're not in a position to financially get into it now, at least you're mentally ready and you're prepared to do it, right? When you can. Because Chris, I know we were in a conversation the other day, and then I'll shut up and let you wrap here is, somebody had mentioned about employers, right? Like if you're getting a job somewhere, and this is even, for a full career, I've never seen it. I've never heard about it. Somebody, they're filling out their paperwork and their employer's walking them through all the benefits or anything to do with their tax forms, right? It's on the person, not the employer. So empower yourself. Ask the questions.
Absolutely, and with someone like Sarah, it's about getting, even instead of getting a $2,000 refund at the end of the year, maybe she changes her withholdings just a touch, and she gets an extra $150 a month into her paycheck, and you know what? Take $100 a month and start an account that you can start learning about investing in mutual funds or electronically traded funds or stocks, and because at some point, wouldn't you rather learn kind of putting $100 a month in instead of you getting in your 40s and 50s? And now, yeah, maybe you could afford to put $1,000, $2,000 a month into those accounts, and you're trying to play catch up, and you're trying and you don't understand the risks. So for her, and someone like that, there are a lot of, does she need to sit down for 5 hours with a certified financial planner? Probably not at that point. But hey, maybe we'll meet with the representative from her employer-sponsored retirement account and say, "Look, I want to start putting $100 a month into a brokerage account that I could just." Again, it's about creating habits,
And
and
it's so easy to do it now with technology. I mean, there's apps out there that do it. I remember, Chris, I mean, this is a long time ago. I used to have to First, I had to find my checks, write a check, drive it down the road to it was a Scott Trade office or
oh yeah,
Scott's Trade, and physically give them the check and wait like 12 days or something for it to hit an investment account. Like now you can get on with like Stash or anything like that, not a sponsor, so we won't mention them again, but uh, you can do it in 30 seconds and you're off and running. Play around with it, right? Now it's not advice I'm giving, it's just an option, but technology is a beautiful thing. Modern day.
absolutely, and for her and, yeah, to put a bow on it for Sarah, this is the time to maybe start looking at building what we call her personal board of directors. Right now, she's single, she doesn't have dependents, but again, kind of aligning yourself with someone that could be her financial a confidant, financial advisor down the road isn't a bad idea as well. So enjoyed this one. Again, this is our most vanilla, straightforward case that we could even imagine. But you can still see within this case opportunities because it's not about today for Sarah. It's also about the next 50 years of setting a path for her for financial success.
You got it, man. That's a great quote right there. So anybody, make sure you remember that, what Chris just said too. And trust me, your future self will appreciate the, 20 minutes or so you just spent with us kind of bantering back and forth on this. But again, check out defeatingtaxes.com. You got the resource links in there. Don't be lazy. And if you're in that younger age, early earning years, take advantage of it. And again, even if you're not ready to financially dump into it, think about it as filling your bank account with knowledge. Ask those questions. Trust me. We are happy to answer questions. People in the community are happy to answer questions. Take advantage of it while you can. It's a great era to be alive. So check it out. Take advantage of it. We'll see everybody back here again next week. The Teaching Tax Flow podcast. Have a great weekend.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciuro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.